Price action in forex trading refers to the analysis of the movement of currency prices over time. It involves studying historical prices and patterns without relying on technical indicators. Traders use price action to make decisions based on the raw price movements observed on charts. Here is what every trader should keep in mind anytime they want to execute trades using pure price action. And now traders, let's start with this crucial topic before anything else. Traders, do you know that supply zones are found when the market makes a large move down from either a single candle or a small consolidation structure, also known as a base? While demand zones are found when the market makes a large move up again from a single candle or a base. Drawing the supply and demand zones is simple for a supply zone. You want to mark the area from the open of the less bullish candle before the drop, which created the supply zone, up to the most recent high before the drop. For a demand zone, you mark the area from the open of the last bearish candle before the drop, which created the demand zone, down to the most recent low before the up move. If you want to know more about how to find and draw supply and demand zones, make sure you watch this video first. Now there are 4 types of supply and demand defined by how the price approaches the supply and demand zone and how it leaves the zone again. I've grouped them into continuation structures and reversal structures. Continuation price structures include drop-based drop and rally-based rally patterns. Reversal price structures are drop-based rally and rally-based drop patterns. So let's analyze each of these structures one by one. The rally-based rally is a type of demand zone which forms during an up move, being a continuation pattern. The market structure is very simple. In this example, you can see we first have a rally, then a consolidation or the base, and finally another rally, which creates the demand zone. A rally-based rally will always form a demand zone. It can never create a supply zone. The drop-based drop is the exact opposite of the rally-based rally, with the one similarity being they both form during trending movements. A drop-based drop will always form a supply zone, a zone which, if the market returns to, should push the price back in the direction of the movement that created the zone. In this example, a drop lower created the supply zone. So if the market will return to the zone, it should push the market lower. Now the big question, what creates the drop-based drop or the rally-based rally structures? Both zones forming the market because of bank traders taking profits of their existing trading positions. In this example, during the first rally, we had bank traders placing long trades when the bank traders are in profitable trades. They'll want to secure some of their profits. When they decide to do this, they consume all of the buy orders coming into the market from retail traders who have begun entering along trades due to the size of the rally. This consumption of buy orders means that the market makes a small move lower and creates the base of the potential demand zone. The move lower causes a large number of retail traders who went long on the rally higher to close their trades at a loss, which puts a lot of sale orders into the market. In addition to this, there will be a small number of retail traders thinking the move down is a trend reversal, meaning they'll place sell trades with the expectation that the market is going to move lower. With these two sets of retail traders putting sale orders into the market, the banks now begin buying again, knowing they'll make the market move higher, and in the process cause anybody who sold the move to close their trades at a loss, which ends up being the bank traders' profit for the drop-based drop structure. The exact same process takes place, only the other way around. The banks take profits from sale positions, which stops the market from falling. Then as the market begins to retrace against the trend, the retail traders who sold late into the down move close their trades at a loss and reversal. Traders begin placing buy trades because they think the trend is changing. Both of these traders are putting buy orders into the market. The banks start selling again at the supply zone, and all the traders who placed buy orders are now losing money.
hypnotized. What's up is down, what's left is right. Chasing stars and holding you. I can't see the end, but we'll see it through.
The drop-based rally is a structure which always forms a demand zone in a market. These zones differ from the first-to-price structures mainly because of their location in the market. If a rally-based rally and a drop-based drop zones only form during trending movements. The drop-based rally zones will only be found when the market changes from moving down to moving up. So it's a reversal pattern. On the opposite side of the scale, we have the rally-based drop zones. These zones form when the market reverses from moving higher to moving lower. And when this construction is complete, a supply zone will have formed in the market which should cause the market to fall again. A reversal structure. What creates the rally-based drop or the job-based rally structure? The drop-based rally and the rally-based drop zones are created by bank traders either placing trades to make the market reverse or by taking profits of their existing trading positions. Very important, the rally-based drop or the job-based rally zones which form when bank traders are taking profits have a lower probability of resulting in successful trades than zones that are created because of bank traders placing trades wanting the market to reverse. To understand why, we must analyze and try to find the intentions of bank traders when they are placing trades. If a bank is placing trades in order to make other traders lose money, the area at which they have placed their trades is important as they have an interest in keeping the market price from breaking that area in supplying them and trading. This means when a rally-based drop or a job-based rally zone is created by bank traders placing trades wanting the market reverse. The banks must keep the market from moving past the point where they have entered their positions in order to protect the trades they have placed. In this example, we can see a drop-based rally zone after the market has been falling. When the banks enter into their long trades, they consume all of the sale orders coming into the market and the price begins to rise, breaking the swing high found at the top of the last move lower. Soon after the break of the high, we see a large drop taking place. This drop causes a lot of retail traders to start shorting, thinking the move higher was simply just a pullback to the downtrend. When the market comes into contact with the demand zone, which was created by the first phase of buying, the banks buy again. If the banks didn't buy and the market fell below the demand zone, then they would have been put at a loss on their positions and would have to liquidate their buy trades. Of course, it's highly unlikely for this to happen because the banks always make sure to plan their trades in advance. The main problem with the job-based rally or the rally-based job zones is determining if the zone has been created by banks placing trades to make people lose money or by taking profits of their own positions. To find out whether the zone you're looking at has been created due to profit-taking or from bank traders placing trades. This requires you to be able to understand the mechanics of where the supplier-demand zone has formed in relation to the current trend on the time frame. You're observing the first piece of market structure in a rally-based drop is a rally. The analysis of the rally is what will give us clues in figuring out the reason why the zone has been created. The size of the candlesticks which form the rally or the drop, along with the understanding where the weeks are on the candles, can give us the information needed to find out why the zone has been created. Check out this rally which took place at the end of this down move. This move up most likely occurred due to professional traders facing buy trades. The way I can determine this is by looking at the previous moves up in a downtrend. It's all about previous price action. None of the previous up moves against the trend moved up in a strong manner. The bullish candles were either small or had wigs present at the top of the candles, which shows us someone was selling even though the market was moving higher. Each one of these utmost were created by bank traders taking profits of their sales positions. Now, if we look at the final up move, we can see the rally was much greater in size than the previous up moves. These candles were far greater in size than the wool candles from the previous UPSing. Remember this, the banks will only cause a reversal when there are enough retail traders for them to make a lot of money off the appearance of a supply or demand zone. When the market has only been moving in the same direction for a short length of time means there won't be many retail traders entering trades. Therefore, the banks will not be able to make a lot of money if they cause the market to reverse because only a small amount of traders will be liquidating their losing positions. Here's another drop-based rally zone. There are two clues which made this structure an important area on the chart. The first was the rally out of the zone. The candles which made up the rally were large bullish candles which pushed the market a large distance against the previous down move. These bull candles contained very little selling, meaning it's unlikely the banks were placing sale trades as the market rallied higher. The second clue was the fact that rally managed to break the most recent swing high. If you plan to trade rally-based drop or drop-based rally zones, the best piece of advice I can give you is to make sure the zone you're trading breaks a recent swing high for a job-based rally zone or a recent swing low for a rally-based drop zone. If the rally in a job-based rally breaks an old swing high, there is a much higher chance the zone will result in you having a successful trade than if no swing high was broken. The same is true for a rally-based drop zone. If the drop pushes the market below recently formed swing low, there is a high probability of the zone working out profitably.
So high I'm hypnotized. What's up is down, what's left is right. Chasing stars and holding you. I can't see the end, but we'll see it through.
Now, you know what to look for when drawing your supply and demand zones.